Right now, a single phone call may have just cost the United States its strongest bargaining chip in North America. And almost nobody in Washington saw it coming. Before we get into it, hit subscribe so you don't miss the next update. This channel is Wealth Hack, and we break down real market moves. Let's get into exactly what just happened. For over a year, the trade relationship between Washington and Ottawa has been a rolling series of threats, deadlines, and last-minute walkbacks. Tariffs went up, counter-tariffs went up. Industries on both sides absorbed the damage quietly, while politicians on both sides claimed they were winning. But somewhere in the middle of all that noise, Mark Carney made a decision that analysts are now calling the biggest miscalculation of the entire trade war. Not for Canada, but for the United States. Here's the setup. Washington has spent the better part of 2 years assuming Canada had nowhere else to go. That assumption wasn't unreasonable. For decades, the overwhelming majority of Canadian exports flowed south, across a border that barely felt like a border at all. That kind of dependence is leverage, and Washington knew it. Every tariff threat, every deadline, every ultimatum was built on one core belief. Canada needs America more than America needs Canada. Carney understood that belief better than almost anyone walking into these negotiations. He didn't spend his career in politics. He spent it running central banks, first in Ottawa, then in London. That background means he doesn't think in terms of press conferences and campaign rallies. He thinks in terms of balance sheets, currency exposure, and structural leverage. And when he looked at Canada's negotiating position, he saw the same flaw Washington was counting on: too much dependence on one buyer. So instead of matching threat for threat, Carney did something quieter. He started building alternatives. Trade conversations with partners outside North America accelerated. Diversification stopped being a talking point and became an actual strategy. And that's the part Washington underestimated completely. Every new market Canada opens up is one less point of leverage the United States holds over the next negotiation. This is where the mistake comes in. Tariff threats work when the other side has no alternative. They stop working the moment the other side does. By escalating aggressively while Canada was quietly diversifying, Washington may have accelerated the exact outcome it was trying to prevent: a Canada that no longer needs to blink first. Industry groups on the American side have started noticing this shift, even if politicians haven't said it out loud. Manufacturers who rely on cross-border supply chains have quietly pushed back against escalating tariffs, worried about exactly this dynamic. Auto parts, steel, aluminum, lumber, all of it moves back and forth across that border multiple times before it becomes a finished product. Every added tariff doesn't just hit Canada. It hits every American company plugged into that same supply chain. That's the part most headlines miss. Trade wars are rarely one-directional, no matter how they're framed publicly. When Canada's counter-tariffs hit American exporters, those losses were real and measurable. Multiply that across multiple sectors over an extended period, and the cost to American producers starts looking less like collateral damage and more like a structural problem. Meanwhile, Carney's approach has stayed remarkably consistent throughout. He rarely raises his voice publicly. He avoids matching aggressive rhetoric with aggressive rhetoric of his own. Instead, he lets economic pressure do the talking, one quiet decision at a time. That restraint isn't passive, it's calculated. It's the same instinct that shaped decades of central bank communication, where a single careless word can move currency markets overnight. Compare that to a negotiating style built on unpredictable, shifting deadlines. Every sudden reversal creates short-term headlines, but it also creates long-term uncertainty. And markets hate uncertainty more than they hate any specific, known outcome. Businesses on both sides of the border have had to delay investment decisions, simply because they don't know what the rules will look like next month. That hesitation has its own economic cost, one that compounds quietly in the background while everyone watches the tariff headlines instead. So what does this actually mean going forward? If Canada continues expanding trade relationships beyond North America, every one of those deals chips away at the leverage Washington has relied on for decades. That doesn't happen overnight, and it doesn't make for a dramatic headline. But it's the kind of shift that changes the entire structure of the negotiation, not just the outcome of a single round of talks. Washington's mistake wasn't imposing tariffs. Tariffs are a normal, if blunt, negotiating tool. The mistake was assuming Canada had no other move to make. Carney's entire strategy has been built around proving that assumption wrong, patiently, deal by deal, without ever needing to raise his voice to do it. That's a lesson worth remembering the next time a tariff deadline dominates the headlines. The loudest move in a negotiation isn't always the one that wins it. Sometimes the real story is happening quietly, in the deals nobody's covering yet, while everyone's watching the deadline instead of the leverage shifting underneath it. We'll keep tracking this one as it develops, because the next few months could look very different depending on which side actually adjusts first. If you found this breakdown useful, hit subscribe so you don't miss what comes next. Drop a comment telling us who you think comes out ahead in this standoff. This channel is Wealth Hack, and we break down real economic stories every week. Thanks for watching, and we'll see you in the next one.